Capital market due diligence is done by analyzing a company's financial statements, which consist of income statement, balance sheet, and its cash flow statements. This helps by reporting a company's financial performance over a specific accounting period. Income statement is also known as the profit and loss statement. The income statement primarily focuses on the company's revenue and expenses during a particular period. Income statement structure. Net income equals the total revenue or gains, such as interest earned in a case of a lending business and fees charged, minus the total expenses or losses, which are capital lend, loan losses, and provider fees. Total revenue is the sum of both operating and non-operating revenues, while total expenses include those incurred by primary and secondary activities. Understanding the income statement is an important part of a company's performance reports that must be submitted to the SEC, Securities and Exchange Commission. An income statement consists of revenue, expenses, gains, and losses. It does not differentiate between cash and non-cash receipts. Differentiating between the terms is key to understanding a company's income statement. Let's take a deeper dive into these terms respectively for better understanding. Revenue and gains. Operating revenue is the revenue from primary business activities. Non-operating revenue is revenue from non-core business activities, aka secondary revenue. Gains are income from other activities. An example is asset sales. Revenue is not to be confused with receipts. Revenue is a recorded period in which sales, services delivered. Receipt is cash received and accounted. Expenses and losses. Expenses is the cost of a company to continue operations and maintaining in business. Typical items that make up the list are employee wages, sales commissions, and expenses for utilities like electricity and transportation. Secondary expenses are expenses linked to non-core business activities, like interest paid or loan money. However, real-world companies often operate on a global scale and have diversified business segments. Such wide array of operations and diversified set of expenses leads to multiple and complex accounting entries in the income statement. Essentially, the different measures of profitability in a multiple-step income statement are reported at 4 different levels: gross, operating, pre-tax, and after-tax. Uses of income statement in due diligence. The main purpose of an income statement is to convey details of profitability and business activities of the company to the stakeholders. It also provides detailed insights into the company's internals in comparison across different businesses and sectors. Based on income statements, management can make decisions like expanding, increasing production capacity, increasing utilization or outright sale of assets, or shutting down a department or product line. Research analysts use the income statement to compare year-on-year and quarter-on-quarter performance. An income statement provides valuable insights into a company's operations. It shows the efficiency of management, underperforming sectors, and its performance relative to its industry peers. Balance sheet reports a company's assets, liabilities, and shareholder equity at a specific point in time. A balance sheet provides the basis for computing rates of return for investors and evaluating a company's capital structure. In short, the balance sheet provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. Fundamental analysts also use balance sheets to calculate financial ratios. Understanding a balance sheet. The balance sheet adheres to the following accounting equation, with assets on one side, and liabilities plus shareholder equity on the other, balance out. This is because a company has to pay for all the things it owns, assets, by either borrowing money, taking on liabilities, or taking it from investors, issuing shareholder equity. Components of a balance sheet. Assets are cash or equities that can be turned into cash. Examples are cash and cash equivalent, marketable securities, accounts receivables. Liabilities is the money owed to an outside party. Examples are bills payable, interest on bonds, bank indebtedness. Shareholder equities is the money attributable to the owners of a business or its shareholders. Retained earnings are net earnings reinvested into the business, used to settle debt. The balance is distributed to the shareholders in the form of dividends. Uses of a balance sheet in due diligence. It is an essential tool used by executives, investors, analysts, and regulators to understand the current financial health of a business. However, because a balance sheet only shows a snapshot in a given period of time, it is not sufficient and should be used alongside the income statement and the cash flow statement to fully analyze a company's finance. Cash flow statement is a statement that provides data regarding all cash inflows and outflow of a company during a given period. Cash inflows are receivables from its ongoing operations and external investment sources, while cash outflows are payments for business activities. It offers investors and analysts a portrait of all the transactions that go through the business. The cash flow statement is believed to be the most intuitive of all the financial statements because it follows the cash made by the business. Net cash flow is measured through operations, investment, and financing. How a cash flow statement works. The cash flow statement is focused on cash accounting. It helps potential investors to understand the company's cash movement, which is also important in due diligence. If you recall from the previous module, follow the money is key. Cash flows from operations, CFO, includes transactions from all operational business activities. This section reports cash inflows and outflows that is directly from a company's main business activities. These are the buying and selling inventory and supplies, along with paying its employees their salaries. It is used to determine how money is spent in operating a business and its sources of income. Cash flows from investing, CFI, is the result of investment gains and losses. This includes cash spent on property, plant, and equipment. This is where analysts look to find changes in capital expenditures, CapEx. Companies with high CapEx are growing. Cash flows from financing, CFF, or a cash flow loan, uses the generated cash flow as a means to pay back the loan. CFF activities are cash transactions related to the business raising money from debt or stock, or repaying that debt. It is used to determine how much money the company has paid out via dividends or share buybacks. It is also useful to determine how a company raises cash for operational growth. All three financial statements should be used to conduct a proper due diligence analysis of a company. Unit economics. Like the name describes, it breaks down your business into measurable subparts, shows business performance within each subpart, and acts as a guide on where to improve. If you perform well on your unit economics, you have a solid base to build the rest of your business upon. Now, let's get into the specifics of unit economics in a lending business. The average loan amount depends on the total size of your available financing to be lent, and your risk appetite. Average loan amount equals available finance to lend plus risk appetite. This determines the concentration of your portfolio. Higher the concentration equals larger the fluctuations in your portfolio performance. The types of loans, such as consumer, business, and merchant credits, target customer base, and credit risk will affect your average loan size. Cost of acquisition. Firstly, the cost of acquisition can be broken down into two parts: marketing and sales costs and the cost of underwriting. A more efficient marketing will mean the lesser cost of acquisition. Fintech can help lower the cost of acquisition in terms of conversion rate, UX, UI, a web interface which helps customer better understand the project, which will lead to a behavioral flow of conversion rate. Technical performance, page speed. Optimizing your page speed may be easily overlooked but has a large impact on how many of your visitors drop off when browsing your page. Simplify loan application process. By implementing accounting software's APIs to get access to lenders' latest financial statements and invoices. Optimizing your website layout and speed, as well as shortening your loan application flow, can have a major impact on your conversion rate. Retention rate is how long customers continue to use your services, product. In lending, this translates into how many times your customer comes back to take another loan or how often they refinance their first loan. Maintaining retention rate may be difficult, as it is a low engagement product, but here are some ways in which fintech can help. Automated email campaigns that are customized emails for each client with details depending on their loan maturity. Improving the loan repayment experience by offering various options of repayment, credit card, direct debit, or any other payment methods, plus an invoice can be used as a medium to communicate with your client and leading it back to your website or application, increasing the chances of upselling. Providing additional value, services such as analytics, budgeting tools, and etc. that customers may find useful is a good medium of increasing engagement with clients and upselling opportunity. Underwriting cost is the cost of assessing financial risk and getting the necessary data to assist in making an accurate decision. Underwriting helps to set fair borrowing rates for loans and create a market for securities by accurately pricing investment risk. Data services used to acquire data are credit bureaus, bank account data services, and accounting data APIs, to name a few. Uses of fintech in acquiring data for underwriting cost. Setting up API integrations to access this data, it becomes much easier to save it in a database, which later on can be accessed and reused either when making a second assessment of the same client or when recalibrating your credit models. Automating credit decision processes. Automating parts of your underwriting processes allows you to decrease the time of manual work assessing loans and in turn decreasing underwriting cost. As time spent on assessing loan application equals a higher underwriting costs. We hope that the video helped you understand the importance of capital market due diligence and how fintech can assist in some ways to bring down the cost. If you found this video useful, please drop us a like below.